Geraldine Sundstrom, let's take the finance of bonds and bring it over to equities. And it's the money question right now. Do you look at dividend growth and dividends as a substitute for yield?
Well, certainly the market has been doing this, especially in the case of euro, because of negative yields, and equities are becoming some kind of ersatz for yielding assets. From here, two possibilities. Either the tensions and uncertainty that we are seeing are not solved and continue to deteriorate, in which case we'll have to face a recession and equities might have a harder time, and certainly some dividend would have to be cut. So a little bit of caution on that side. On the other hand, currently the earnings, even though they are in recession, earnings growth is not negative enough to, warrant deep cuts in dividend, and therefore equities are a great substitute for many investors that are facing negative interest rates.
And couple that with your late cycle view and take it back to the bond market, would you still be preferring sovereign debt over corporate credit then globally?
Well, in general, we want to be cautious and prudent in a late cycle. So in terms of corporate debt, we still have some, but we want to have much more high-grade debt and securitized debt and steer away from, too junk debt or subordinated debt. Doesn't mean, there are exceptions on both sides, but in general, if you go more lower grade debt, then keep your maturity relatively shorter where you have visibility of cash flow. But generally speaking, in terms of portfolio construction, government bonds still offer, the right correlation, even though the room for rally in many places is relatively contained.